What is up everybody, Gifford here and welcome back to another stock market video, and today we're going to look at 3 stocks that I'm going to be buying in the future. But before we get into that, I just want to bring up the recession fears that's been happening in the market and the volatility. So here's an article for Goldman Sachs warns that Russia's war on Ukraine could plunge US and Europe into recession. So we have uncertainty with the war and also the interest rates going up to combat inflation, which means that there's going to be less money floating around for the average person. So all these companies are going to be focused on profitable companies with increasing revenue, and I've also got one bonus one at the end, so stick around for that. So the first stock we're looking at is none other than Tesla stock, ticker symbol TSLA. So having a look at its summary on Simply Wall Street, its earnings are forecast to grow 25% per year. Its earnings grew by over 700% in the last year. And while everyone regards Tesla as being overvalued, the future growth of this company is very huge in the next 3 to 5 years. So having a look at this estimates for December at 2024, they reckon that the revenue is going to increase to $126 billion and also have earnings, which means they're profitable with $18 billion. So having a look at the earnings and revenue history, we can see that Tesla has high quality earnings, also that the growing profit margin. Tesla's current net profit margins is 10.3%, which is higher than last year of 2.2%. So my buying range for Tesla is about $700 to $800, which will give me a forward PE of 50. So right now, the current PE right here is 184, which is March 18th when I took this, 2020. And so if I'm buying at these prices and I'm hoping that Tesla is going to be a lot higher, I reckon at about 1400 to 1500 at the end of the year, if nothing too crazy happens, that will then give me a PE of 50, which seems reasonable. So remembering that value stocks are regarded as good buys when they're about PE 10. So another thing in this article is that Tesla could deliver 1.5 million cars in 2022, and this is boosted by the fact that 2 factories are going to come online this year, which means they're going to have a really high chance of meeting that target. So next I want to go into the Q4 2021 financial summary, and I want to look at specifically the automotive gross margin increasing. So highlighted here shows you 24% and then increasing to 26.5 to then 28% to 30%. What this shows is that their profits are actually growing as they make more cars, which means they're getting more efficient and each car they build is selling for more money. Next to highlight here is page 8 of this Q4 2021 summary, and we can see here that in 2017 they made 101,000 cars, and then we can see it increasing every year. And over here in 2021, last year, they made 930,000 cars, and year to year that's an 83% increase, which is massive. This company is executing and growing at the highest levels. So sorry if you couldn't see that before, but there's the actual deliveries for 2021, which is 930,000. I'll just move my picture down a little bit, and let's just calculate and how they got this 83% increase. So bring out my trusted calculator. If we go 509,737, take away 930,422 is how many they had. If we then minus that, divide that by 509,737 multiplied by 100%. So we have here is 82.529%, and if you round that up once, you get 83%. So let's now clear that and have a look at how much they would need to grow to be able to reach that 1.5 million cars this year. And remembering they've got 2 new factories coming online. So let's now try to calculate that with 1.5 million cars and see how much they need to increase. So go 1.5 million cars, and then we take that away from 930,422, gives us that. We then divide by how much cars they made in 2021, which is that many, multiplied by 100. So we can see here that it gives us 61.217, which means that they would only need to increase 61% from what they did in 2021 to be able to get the 1.5 million cars in 2022. With 2 new factories opening up, they're easily going to achieve that. And the scary thing about this production rate of Tesla is that in 2018 to 2022, they were only actually growing by 40%. Now they're growing by 80%, or at least over 50% in my calculations. So definitely 1.5 million cars is going to be achievable unless something really crazy happens. So another point is that Tesla has decided to put the price up, and this is to combat inflation and also their huge demand. So here's an article from the US, and that Tesla has substantially increased prices for all models. So depending on the model and the version you want to buy, prices have increased from $2,000 to $12,500, which is a significant amount. So going over to the New Zealand Tesla page, if I was to order my Tesla Model 3, which I'm dreaming I wouldn't order one, I can't afford one, but if I was to order one, we can see that the price has actually increased to $72,400. These were under 69,000 when we click this button here. But if we go scroll down, and that's with the incentives, we can see here that the estimated delivery is not weeks anymore, it's actually months, and it's specifically 6 to 9 months waiting time. There is huge demand to buy these cars all over the world. And I've also noticed myself while driving around in Christchurch where I live that I see more and more Teslas on the road, and these cars here are $70,000 to $90,000 EVs, and people are actually buying them. So it shows you that the car is in huge demand. But for myself, I wouldn't buy a Tesla right now because one, I can't afford it, but also I'd rather buy the stock because I know that Tesla, the stock, is going to be worth more in 3 years time than the car. So the second stock I want to talk to you about is Alphabet, better known as Google, ticker symbol GOOG. So let's move over to Simply Wall Street, have a look at the summary, the revenue, past and future performance, and also its ownership. So having a look at Google's summary, we can see that it's trading at 44.9% below its estimated fair value by Simply Wall Street. Its earnings are forecasted to grow 11.19% per year, and its earnings grew by 88.8% last year. And if you're not excited about Google's forecasted growth of only being around about 11%, just remember this company is in the trillions. It's 1.8 trillion and is one of the biggest companies in the world. So that kind of growth for a big company is totally fine, and your money is pretty much safe with these big caps. So looking at Google's future growth, we can see here that the projection is just to make even more money. And at the end over here, we can see that they're trying to reach a revenue at the end of 2024 of $400 billion with an earnings, a massive earnings of $102 billion. And looking at Google's past performance history, we can just see that the revenue and earnings have been increasing to show that the company is very healthy. And during these times of uncertainty, there's a reason why people and investors flock to these large caps, because they have high institutional investors. Google has 67.2% institutional investors, meaning they have put their money into this company and they will not be selling unless it fundamentally changes. Unlike other companies that have a lot of retail investors that can move the stock, Google is very stable, and these companies here are here for the long term, and I don't blame them because their earnings and revenue is growing. Therefore, the share price will definitely grow as everyone realizes. So going over to Ticker Terminal, I just want to show you what some of the analysts and street targets are for Google right now. So the current share price, where is it, is 2,722 as I'm filming this. We can see here that the median stock price has been listed as $3,488. And currently we have 40 analysts covering this, and 35 say that Google is a buy right now. So the other catalyst coming for Google is in July. They're going to be having a stock split. So it's a 20-to-1 stock split. So fundamentally nothing happens with the company. All they're doing is that for one share you own of Google, so one share costs $2,700 right now, you're going to get 20 shares back from that. While the stock split doesn't actually fundamentally change anything about the company except for handing out more shares, what it actually does is now that other investors can get into the stock because of internal conditions in their funds, because sometimes their funds will only buy stocks all the way up to $1,000 per share. Now, because Google is no longer $2,700 after July, the stock price will be closer to $130 to $140 a share, which means that more funds will be able to have access to it than before. And the other big thing I see why Google is going to be popular is because you're going to be able to do options trading, which is what I do on this channel, which means options traders can have access to buy and sell 100 shares of it. So before, if you were an options trader and you're doing options on Google, you would have to buy 100 shares, which means if the share was $2,700, you would need $270,000 worth. However, now if the share price is divided by 20, it's only going to cost you $13,500 to do a option trade in it, one contract of 100 shares. And to be able to trade in Google is going to be beneficial because the company is pretty stable. You're not going to expect these massive drops of 20 to 30% because one, it has high institutional investors in it that are going to hold the price, but also it's a fundamentally good company that makes a lot of money. So unless something changes, which I don't think it would, because Google is an absolute beast in revenue and how it's run. So the third company I'm looking at is ON Semiconductor, ticker symbol ON. So what we're going to do is have a look at the Simply Wall Street summary of it, and then we're going to compare the Q3 2021 to the Q4 2021 financials. So very briefly, onsemi Corporation provides intelligent sensing and power solutions worldwide. So I like onsemi because I have a history and this is my field of work in electronics. We can see here at the upside is that they're trading at 34.7% below the estimated fair value, which is also good. Their earnings are forecasted to grow 22% for this year, and their earnings grew 330% last year. so they are actually growing, even though I'm hoping that this is a more stable company to be in. So hopefully this is not confusing, but I've got the Q3 2021 financial results here, and I've got the Q4 2021 financial results here. And what I really want to point out, if you're trying to look for a company that's growing and also management showing that they're executing everything, I just want to point out the fact of what their outlook is going to be when they wrote this. So this was in the past, they wrote it and they said this is what's going to happen in Q4, and hopefully we can meet it, and then I'll show you exactly what happened. So if we look at the Q3 financials here, they're going to say that in the Q4 this is what they're hoping to get, and in the revenue they've got it in millions, which is kind of confusing because it's thousands of millions. But anyway, they've got $1,740 million to about $1,840 million. That's what they're hoping to get. And what actually happened in Q4 is that, where can they read this here, the record quarterly revenue was actually 1,846. So they beat even the highest estimates, and we can see here that the gross profit margin, they were aiming for 41.8% to 43%, and we can see it's 45% and 45.2% respectively. So without going into the other boring numbers, all I want to show you is that they predicted the revenue is going to be in this range, and when it actually came to the fourth quarter, they actually beat that and actually meet guidance. So they knew what the company was doing and what the growth is, and they can project it reliably. So moving on to this quarterly investors presentation, there's a really good slide I want to show you here on what we're going to expect in Q1 2022. So their revenue for Q1 is 1,850 to 1,950 million that they're going to get, with a gross margin of 45.5 to 47.5. Both of these are increases on what they did last year, so it shows that the company is pretty much growing right now. So this video is starting to get long, but very quickly, my bonus stock is Palantir, ticker symbol PLTR. Now Palantir is currently down 60% from its all-time highs. It's increasing revenue, however I'm mainly using this as option strategy to gain passive income. One of the negatives of Palantir is that they're currently not profitable, and I don't see them being profitable until 2024, although I have read some stuff that they are going to be profitable very shortly, but I haven't yet dived and done my full DD on that. So I'm expecting a conservative 2024 before they become profitable. So it's still going to be a high risk, high reward play for me. I'm only going to be doing cash secured puts in my trading account only. So if you want to know what that is in my options trading account, feel free to subscribe to the channel. I go into those videos about what cash secured puts are and also the options that I do. So just to summarize this video and the stocks that I'm currently looking at, I basically rotated around to larger market cap companies for the protection and the uncertainty of what's happening at the moment. I know that the market can sometimes show green and everything is going up in share price, but I still see a lot of pain going into the next couple of months with the rising inflation rate. People are just not going to be having that much money to be able to spend when it's getting chewed up by inflation, and everything is going to cost a lot more. So all your weekly expenses and bills and the necessities are just going to start costing more because of all the money that's been thrown out in the last 2 years to deal with the pandemic that's happened around the world and all the free cash that's been given out. So if you're wondering what that protection is, and basically I'm focusing on companies with high revenue and they all have a positive PE, which means they are profitable companies. In a rising interest rate environment, the company's expenses are definitely going to go up. Therefore, company profits will be hit, but worst, unprofitable companies will go into more debt, which could lead them into bankruptcy. So having too much debt and then having less demand for the products and services can also mean that they will struggle to attract investors to be able to grow their company. Anyways, that's it for the video. Thank you so much for watching. It is a little bit lengthy, but I really wanted to get those points out because I have shifted a lot of my investing away from the growth stocks and I wanted to include you in it. So before you go, hit that like button to support the channel, and if you want to see more of me, hit subscribe. If you want to hear more from me midweek, feel free to go over to Instagram and follow me there. I also post my trades there as well during the week. The trading platform I use is Interactive Brokers, Hatch Invest, Stake and Sharesies for individual companies, and I use Investnow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. I'm not a financial advisor or a professional stock picker, so none of this is financial advice, and I'm just showing what I'm doing here. Hopefully you do your own due diligence and buy the stocks that you believe in. With that said, thank you for watching and I'll see you in the next one. Goodbye.